The average annual cost for a private nursing home room exceeds $100,000. Assisted living facilities average over $50,000 per year nationwide. 70% of individuals turning 65 will require long-term care services eventually. This need typically lasts for 3 years, devastating unprepared retirement savings. Medicare does not cover custodial care, which is the primary need for long-term services. Medicare only pays for short-term skilled nursing or rehabilitation after hospitalization. Relying solely on government programs is a critical financial mistake. Long-term care expenses are the single largest uninsured risk in retirement planning. Ignoring this risk means potentially liquidating decades of accumulated wealth quickly. We must analyze specific funding mechanisms to protect your financial future. Understanding the true cost is the first step towards effective mitigation. Long-term care involves assistance with activities of daily living, or ADLs. These activities include bathing, dressing, eating, transferring, and continence. Cognitive impairment, such as severe dementia, also triggers the need for long-term care. Custodial care provides non-medical help with these daily living tasks. Skilled care involves medical services administered by licensed professionals like nurses. Long-term care insurance policies typically require inability to perform 2 out of 6 ADLs for benefits to begin. Policies often include an elimination period, usually 90 days before payments start. Home health care is generally less expensive than facility care, but costs are rising rapidly. The type of care needed directly impacts the daily benefit amount required in your policy. Accurate assessment of potential future needs dictates the necessary coverage level. Medicaid is the largest payer for long-term care services in the United States. However, Medicaid is a needs-based program requiring substantial asset spend-down. To qualify, an individual must typically deplete almost all non-exempt assets. Exempt assets usually include a primary residence up to specific equity limits and 1 vehicle. Non-exempt assets include investment accounts, savings, and secondary properties. Gifting assets to qualify for Medicaid triggers a 5-year look-back period penalty. Any transfers made within this period can disqualify the applicant for coverage. This forces middle-class families to impoverish themselves to receive assistance. Proper planning ensures assets pass to heirs instead of being consumed by care costs. Medicaid planning often involves complex legal strategies like irrevocable trusts. Traditional long-term care insurance offers dedicated coverage for future care needs. These policies provide a daily or monthly benefit amount for covered services. Premiums are paid regularly, often increasing significantly over time due to rate hikes. Insurers must obtain regulatory approval for these substantial premium increases. The risk of future unaffordable premiums caused many policyholders to drop coverage. Policy benefits are typically inflation-adjusted using a 3 or 5% compound rider. Choosing a longer elimination period reduces the initial premium cost significantly. Partnership programs allow policyholders to protect assets equal to the benefits received. These state-specific programs offer crucial asset protection against Medicaid spend-down rules. Traditional LTCI is pure insurance, meaning premiums are lost if care is never needed. Hybrid policies combine a life insurance death benefit with long-term care riders. These asset-based policies guarantee that premiums are not entirely lost. If long-term care is needed, the death benefit is accelerated to cover expenses. If care is never needed, the full death benefit pays out to beneficiaries. Premiums are often paid as a single lump sum or over a short 10-year period. This structure eliminates the risk of unpredictable future premium increases common in traditional LTCI. The policy cash value grows tax-deferred, offering additional financial flexibility. Benefits paid out for qualified long-term care expenses are generally received tax-free. Hybrid policies offer greater certainty and control over funding future care needs. They appeal to individuals seeking guaranteed returns on their premium investment.
Certain deferred annuities can be structured to include long-term care riders. These riders allow tax-advantaged access to the annuity principal for care expenses. Withdrawals used for qualified long-term care are often excluded from taxable income. This is a significant advantage over standard annuity withdrawals, which tax gains first. Annuity riders typically offer a leveraged benefit, multiplying the account value for care costs. For example, a $200,000 annuity might provide 3 times that amount for care. Annuities are suitable for individuals with existing savings seeking tax efficiency for future care. They provide liquidity and growth potential while addressing the long-term care risk. Funding care through annuities avoids the stringent underwriting required for life insurance hybrids. The Secure Act 2.0 further enhanced the use of annuities in retirement planning. Premiums paid for qualified long-term care contracts may be tax-deductible. The Internal Revenue Service sets annual limits based on the taxpayer's age. These limits are adjusted annually for inflation and are substantial for older taxpayers. Deductions are only available if the premiums, combined with other medical expenses, exceed 7.5% of adjusted gross income. Self-employed individuals can often deduct the full eligible premium amount directly. Benefits received from qualified LTC policies are generally excluded from gross income. This tax-free status applies up to a daily limit set by the IRS, currently around $400. Exceeding this limit requires substantiation of actual expenses incurred. Understanding these tax rules maximizes the efficiency of your funding strategy. Consult a tax professional to confirm your specific eligibility and deduction limits. Self-funding involves earmarking specific investment assets to cover potential care costs. This strategy is viable only for high-net-worth individuals with substantial liquid assets. The required portfolio size must account for inflation and potential market volatility. A common rule suggests needing at least $3 million in liquid assets for self-insurance. Utilizing tax-advantaged accounts like Roth IRAs is highly effective for self-funding. Qualified withdrawals from Roth accounts are tax-free, including earnings used for care. Investment returns must consistently outpace the rising cost of long-term care services. Risk pooling through insurance transfers the catastrophic financial risk away from your portfolio. Self-funding requires rigorous discipline and continuous monitoring of investment performance. Most families benefit significantly from transferring risk through insurance products. Legal documents are essential regardless of your chosen funding method. A durable power of attorney for finances grants authority to manage assets if you become incapacitated. A healthcare power of attorney designates someone to make medical decisions on your behalf. Without these documents, a court conservatorship process becomes necessary, which is costly and slow. Revocable living trusts are often used to manage assets and avoid probate court proceedings. Trusts ensure seamless asset transfer and management during periods of incapacity. Specific trust structures can also protect assets from future Medicaid recovery claims. Reviewing beneficiary designations on all retirement and investment accounts is critical. Proper legal planning ensures your wishes are followed and minimizes administrative burdens. These steps secure both your financial plan and your personal autonomy.